Bazaar Morning Call, live from the CNBC TV 18 headquarters in Mumbai.
We are going to finish positive on the Dow, up about 30 points. S&P 500 up to 2511.
Guidance for Q1 lower than the original guidance, right? We're now going to be looking for about 84 billion.
As we look at what's going on in China, it's clear that the economy began to slow there for the second half. Trade tensions between the United States and China put additional pressure on their economy.
U.S. futures on the back of the Apple warning, taking a nosedive, really losing their mojo. At this stage, we're looking at a loss of over 300 points for the Dow.
Good morning. Welcome to Bazaar Morning Call. I'm Lata, and with me are Anuj and Surabhi. Well, we just presented what's the global backdrop to you. The Dow did end in flat terrain, all the Wall Street indices. But what happened thereafter was this guidance cut coming in from Apple, as you heard Tim Cook say. And Dow Futures are pointing out to a very different picture. But the other point that we need to note is what's happening in crude. There is a 2.5% gain in crude prices. It still looks like less than 55 to us, but there is a genuine fear that come January, Saudi Arabia is going to cut output, that it will live by that promise. And so there is a niggling worry over there, which has actually helped Australian shares because resources stocks over there are up. So Asia being somewhat in the green may not necessarily work to our advantage, but let's wait and see. The other problem that perhaps we will have to contend with is the growing feeling, as more and more news agencies report, that there is a large farm package coming. CNBC TV18 was the first to report it. We had CNBC Awaz's Lakshman giving us all the three options that the government is considering. Our own Timsi Jaipuria reported about a farm package. And now it's getting the picture of both a basic income plus some kind of a waiver. That's not looking too good. I don't know how the bond markets will react to that, but a spike in yields could again be slightly negative for the equity market. So today looks like the bulls will not come all guns blazing. Also because we are ahead of the earnings season. Morning, both of you.
Good morning, Lada. Good morning, Anuj. Well, yeah, the bulls really had to duck for cover yesterday, at least, the kind of sell-off that we saw in the market, especially in the second half. Now, you add to that the fact that once institutional participation started coming back in, both were on the sell side, FIIs and DIIs, selling off about 600 crores yesterday. That's the foreign money outflow that we saw. The SGX Nifty, for what it's worth, is still holding on to minor gains, as are some of the Asian markets that are trading. You can argue that Hong Kong fell 700 points yesterday, so maybe it preempted some of the US market volatility. But the fact is that the stalking point about Apple scaling back its guidance, that's continuing to reverberate through the global equity space. So we'll see how the US market volatility goes. But Anuj, good morning. So, you've been saying this for a while now, that let's not extrapolate any day's trade.
Exactly.
So is that the feeling that you have this morning? Let's not extrapolate yesterday's fall as well and start afresh?
Morning, yes. Let's not extrapolate perhaps the amount of fall. But the nature of fall, you have to take note of. Yesterday, the way it fell, especially in the second half. I think the global and local tail headwinds will keep a lid on all the rallies right now. And the market's texture, from being a buy on dips market, is you'll see the smart money trying a sell on rally trade as well now because of the way market fell. I think auto sales yesterday, like we keep repeating ad nauseum, that's a hard data that really moves market, and it did. Not just the individual stocks, that's a different issue, but overall economy facing stocks, it does move. And rupee also, that was also a big trigger yesterday, that also moved. And look at the delivery selling in some of these large names. There was aggressive delivery selling. Eicher Motors has 350 crores of delivery selling, M&M 400 crores, Tata Steel 200 crores, SBI 220 crores, Axis 500 crores, Maruti 220 crores, Reliance 300 crores. So there's some selling. Having said that, the Nifty has well-defined boundaries now, 10,550 to 10,950. We are somewhere in between. buying closer to 10,550 makes sense, selling closer to 10,950 makes sense. And of course, today's weekly options expiry, so perhaps we want to talk a bit about the bank nifty as well.
So absolutely, I mean, banks again also yesterday at least there was sort of no escaping from the selling, and we saw that play out on a lot of the heavyweights as well. So for expiry today, how would you look at things?
Yeah, you know, for expiry, I'm just presenting a picture here, and this is technical, and all bets are off if in first hour itself we start to take out the boundaries. The data indicates that there's been some put spread which have been taken at 26,800 and 26,700. What does that mean? That, you know, traders have bought 26,800 put and sold 26,700 put to sort of cut that cost. So cost comes down to around only 7 rupees. The call being taken here is that if yesterday's low of 27,077 is broken, if that's a big if, and it doesn't look like the base case right now, if that is the case, then the 20 DMA of 26,800 does come into picture, and you know that could happen. But that is only, you know, that's an extreme scenario of the market breaking yesterday's low in the first hour itself, 27,077. If that does not happen, this theory is out of the window, because anyway, it's a spread where, you know, the cost is only 7 rupees. So that's one point. Having said that, on higher levels, there's significant call writing between 27,200 to 27,500, especially at 27,400. My sense is 27,400 will be a huge resistance for the bank nifty in today's trade on expiry.
Okay. All right, yeah, 27,400 has been, you know, it's behaving like the 10,950 on the Nifty. Yeah. So, you know, that will be an important resistance mark to conquer. Could see selling at those levels. Also because we have so many problems for the yield market. But with that, let's take a look at what advice we are getting.
Yeah, absolutely. So let's kick things off. Here are the experts this morning with their word on the market. Rhythm Desai of Morgan Stanley thinks India's growth story is entering a new cycle and continues to like equities and growth stocks at reasonable price. He says there are 4 ways to participate in growth by companies with strong trailing capex, robust trailing book growth, strong trailing positive earnings estimates revisions, or the best forward revenue or EPS growth. He says their favorite growth names include Asian Paints, Bajaj Auto, HDFC Bank, ICICI Bank, ICICI Prudential, L&T and Titan.
All right, and with that, let's get you some money market views as well. Mohan Shenoy of Kotak Mahindra Bank says the slowdown in Chinese economy, continuing trade war and US government shutdown has triggered a risk-off scenario, resulting in volatile equity, currency and commodity markets. He says the yen was the biggest beneficiary as it gained against all major currencies. Though dollar index itself was stable around 96.80, he says continued weakness in domestic equities should cause rupee to lose ground. Mohan expects the USD-INR pair to trade in a range of 70.20 to 70.60 for the day. That's quite a weakness compared to the December 31 levels.
Mohan Shenoy says Brent crude oil price after sliding below $50 a barrel rebounded to 55 levels, which is bond negative. He adds with general elections in India coming closer, fiscal concerns have had a negative impact on the bond market sentiment. He says large issuance of state development loans has caused excess supply pressure in the gilt market. He expects the 10-year benchmark bond yield to trade in a range of 7.35 to 7.40 for the day.
Okay, after a long time, we have almost a full sort of attendance for the global market as well. Here's Mangalam with the world view.
Full house on the global market except the Nikkei, which is still on holiday. But on Wall Street yesterday, you know, there was a lot of turbulence. Eventually, we saw a recovery of almost 1.8 to 2% from the lows for all the major indices. They ended mildly above the flat line. The key outperformer there being Nasdaq, which was aided by Amazon as well as Netflix. However, the big data point in today's trading session will be what happens to Apple, because the company has cut its revenue guidance from $89 to $93 billion to $84 billion for the coming quarter. And this has taken the stock price lower by about 7% in after-hours trade. Yesterday, it ended absolutely flat, but in after-hours, it was down 7%. And Apple's not a dinky toy stock, has about 10% weight on the Nasdaq, 7th heaviest weight on the Dow Jones as well. But the stock is about 32% lower from its record high. So let's see how much of that perhaps could be priced in or not. The US futures, on account of that, indicate a slightly muted start. Across the Atlantic, in the European region, most of the markets ended absolutely flattish, recovered from the lows. The the French index was the key underperformer with a cut of about 0.9%. One sector that did not do too well was the basic minerals as well as metal sector, just the way Indian markets saw metal stocks decline on account of lower global growth fears. Asian markets, apart from the Nikkei, all the other indices that are trading that have recovered from the lows. Kospi opened with a 0.4% cut and now has recovered above the flat line. We have the Hang Seng and the Shanghai also in the green. As a result of that, the SGX Nifty indicates a mildly tepid start, a bit of a bounce back from yesterday's cut.
Thanks, Mangalam, for that. Let's now move on. We have Jeffrey Dennis, emerging markets commentator, joining in to talk about the global setup now that markets are back full throttle in the new year. Jeff, thanks so much for joining in. Season's greetings to you. First of all, wish you a very happy new year. So this big growth concern that's hanging like a cloud over global equities, particularly the U.S. market, do you think that a major slowdown is in the works in the U.S.?
I think that's absolutely right. I think a big slowdown is in the works. It's obviously been, Happy New Year, by the way, to you as well. It's been a very turbulent first full day, of course, of markets in 2019. I think the key statistic in the markets at the moment is this extraordinary rally in U.S. bond prices since middle of the fourth quarter. Yields going from close to 3.2 to close to 2.6%. That is telling you, I think, that not only are inflation expectations under a bit more control than perhaps had been feared, but it's also telling you the market is very concerned about a big slowdown in the U.S. economy and possibly even a recession, although I think that's still unlikely. And yet you had an enormous sell-off in the U.S. stock market in the fourth quarter. So that's getting itself priced in. And as you know well on the program here, it's really been more concerned to think about the Chinese economy that has really given you this volatility early in the year and, of course, played a role in Apple's, the cut in their revenue guide.
Okay, well, Jeff, good evening and Happy New Year from me as well to you. You know, the Fed chair, Powell, is to speak on Jan 4th. That's day after tomorrow for you, tomorrow for us. Are there any expectations that he will actually refer to a possibility of the contraction of the balance sheet timetable already also up for review? Were he to say that, what could happen? I mean, what are the chances he'll say it?
I doubt it for a number of reasons. First of all, I think they're on a long-term program on balance sheet reduction. I think if you're going to see the Fed responding to the softness of the economy, the expected softness in 2019, which I think ultimately they will do, they'll do it more initially by some slightly more dovish interest rate guidance. And yet, I think that's pretty unlikely quite so close, so with the FOMC meeting having been so much in the recent past. And so I think you've probably got to wait a little bit longer. But I think we're lining up now for a much more dovish Fed in 2019. I've said for a while, and I've posted this on social media, that I think there's a very good chance the Fed doesn't raise rates at all in 2019. But I'm not sure this is the platform that Chair Powell would talk about this. And I think they do it through interest rate policy, as I say, not by changing the program, if you like, on balance sheet reduction.
Jeffrey, hi, good morning. Happy New Year to you from my side as well. Your thoughts on India, because in December we had a big outperformance compared to the MSCI emerging market and MSCI Asia ex Japan. But, yesterday's auto sales data put a bit of a dampener. And there's some concern that now we are headed into election season, so perhaps there's going to be some issue with the fiscal issues. You think those issues are real, or you think India can still outperform?
I think they're real. I think there's a number of things to say here. First of all, of course, emerging markets outperformed quite significantly developed markets in the fourth quarter, particularly towards the end when the U.S. market came under pressure. Asia, of course, did worse than Latin America, which, of course, had a very fast start to this year as well. So I think you've been in a situation where India's not only outperformed EM, but EM has actually outperformed the developed markets, especially the U.S. Europe had a terrible year last year. So I think going forward, we got to put into context with what developed markets will do. I think developed markets bounce in 2019 because a lot of bad news is now priced in, and I think emerging markets will also bounce. I think in that environment, it's unlikely that India will sustain that outperformance because the currency, as you mentioned at the beginning, is pretty robust again, albeit the dollar's fairly flat. And, of course, as everybody knows here, you've got the election coming up, you've got risks to fiscal policy. So if my view of this year comes true, which is that you will get a modest bounce in emerging markets, I think there's enough uncertainty about the Indian situation, including the economy, that I doubt it's going to be an outperformer.
Oh, okay. Well, thank you very much, Jeff Dennis, for putting all those cards on the table. We will have to see, of course, how the fiscal largest spans out. It should come in the coming days. But thank you very much and have a great 2019 year again.
Thank you. Thank you very much.
Okay, actually, the fear that you might see a very large farm package is getting louder by the day. Like I told you, it first broke on CNBC TV 18 and CNBC Awaaz when our reporters put out those three options, possibly a Bhavantar kind of scheme, which will bridge the gap between MSP and the market price by putting the money in Jan Dhan accounts. That was a 50,000 crore bill, according to Lakshman of Awaaz, or a 1 lakh crore bill, which would be a farm income, or a 3 lakh crore, which would be a national loan waiver. Yesterday, you know, all this got a boost further with one of the news reports saying it could be a 2 lakh crore package. Let's see how the markets are going to read it. We have someone who watches the treasury of ICICI very closely. Joining us now is B. Prasanna, head of global markets at ICICI Bank. Prasanna, good morning. Thank you very much for staying back for us. I know in a few minutes you'll have to board a flight. But what did you make of this increasing noise that we could see a large farm package?
So, yes, there's a steady increase in noises as far as the farm package is concerned, Lata. And actually, over the weekend, we had the Prime Minister in his interview clearly saying that farm liberalism is not going to be the preferred giving this largest, which I think made a lot of sense. But at the same time, I think they are clearly looking in terms of rural households and the rural community, basically because the growth there has taken a hit. Purely from an economic, these things might do good and might actually fill up the rural consumption. But from a fiscal perspective, we need to watch out to see whether the current fiscal discipline, which the government has been appreciably holding on for the last 4 years, how to bring this entire thing within the fiscal metrics of the government. Okay. So I think the bond markets in general, as well as the currency markets, will need to watch out for that particular aspect. I don't think the base case belief is that fiscal deficit will be impeached upon. I think we all still believe that the government, which they have been doing for the last 4 years, and will broadly stick to the deficit target. So we'll have...
Okay. Well, I think, Prasanna, you'll have to hold the phone closer to your mouth and speak a little louder. Well, let me just add to that question. You know, at the moment, the Reserve Bank is in a big buy mode, and therefore it's going to, keep probably a cushion. Yields cannot rise beyond a point. But how will the bond market discount what happens for the new government? Because whatever the government announces, if it's a 2 lakh crore package, they won't have the time to spend it now. So it will more or less be for the coming government. So do bond yields react today, this month, or will all this only be reacted, the markets will react only much later, probably May?
So there are 2-3 things, Lata. So the first thing is the fact that for every news which gets broken in the media, markets will be reacting immediately next to when the news happens. So from that perspective, there might be a reaction today to the extent of 5 or 6 basis points higher. But like you said, the RBI is also buying bonds, and they are really buying around 75 to 80% of the yearly borrowing target. So to that extent, the yields will be capped, will not be able to go up too much because there is enough buyers in the market. And then the third reason is the long-term reason. Now, like you rightly said, these are announcements. Even if it does come, these are announcements, and they are not going to be spent immediately. So the actual cash flow for the government is going to get hit much later, maybe next year or maybe second half of next fiscal year. But when market takes a view, it has already started focusing on what is going to be the gross borrowing number for the next financial year. So even at a 3.3% fiscal deficit, numbers, gross borrowing numbers are ranging between 6.5 to 7 lakh crore, depending upon how much of buyback which is being budgeted. So from that perspective, I think there are issues with respect to fiscal. So I guess yields will not go up too much because of the buying that happens from RBI, but they will wait and watch to see what kind of space the government makes from the fiscal side if they do announce a farm loan kind of a package.
Take your point, Prasanna. That explains why perhaps despite all of these concerns, we're still in that range of 7.3 and 7.4 in the 10-year. A word on the currency as well. You know, this dramatic move that we saw on the rupee yesterday, the currency sliding a whole 1%. Yes, the dollar index has also moved back to about 96.60 thereabouts. But are these concerns playing out in the rupee market? What caused this big move and your immediate outlook?
So actually, there are a couple of reasons on the currency as well. So one of the reasons is the fact that there was a growth scare pertaining to China and emerging markets yesterday, which broke out after the PMI index from China came much lower than expected and in fact into contraction territory. So that was a shocker. And so if China is going to have a slowdown in growth, that's going to impact a lot of countries in Asia, which will be exporting and which are very much highly dependent on exports to China and to exports to the rest of the world. So from that perspective, if there is a global growth slowdown, which is driven not just by the US but also by China, then it is going to impact a whole lot of EM countries as well. So I think that was the risk of sentiment which happened yesterday morning. And initial part of the day, I think rupee didn't fall because of some capital flows, which is what is rumored in the market. But during the second half, post-European opening, when Dow also fell and the European stocks also started falling, I think the rupee reacted to the movement which happened in EM currencies. The second reason was the starting point for yesterday's dollar rupee rate was also, I would say, maybe not the right level, because we traded on a New Year day, which was, I think, a very, very illiquid day. And there was a tremendous appreciation on that day to 69.40, which possibly was not the right level, if you would say there was no more liquidity in the market.
Okay, so why don't you leave us with your range for the near-term range for the rupee? How much can it depreciate, as well bond yields?
So for the rupee, Lata, I would say that the medium-term bullishness still remains because of the fact that oil has fallen dramatically from the 80s to the 50s range, notwithstanding yesterday's rise of around 3-4%. So that gain is definitely there, giving a slight bullish bias to the currency.
Okay.
But at the same time, I think Reserve Bank will not let it appreciate too much, and also the EM scare which is happening. So I guess the range would be in 750 to for the next 1 week or so, and 70 to 72 for the entire of next year. So that's the range I'm looking at. And from a bond yield perspective, I think pretty much 725 to 745 kind of a range should hold true for the next one month or so, till the time the budget is announced.
All right. Prasanna, thank you very much. And I think now you must go and catch your flight. Thank you for joining us. So, okay, it's not a very big depreciation that is expected in bond prices either. 7.45, but let us see. It's still in the nature of rumors. We don't know what the exact package would be.
Oh, well, I guess the saving grace is the RBI is standing buying bagfuls of these bonds throughout the month. Okay, all right. On that note, let's now move down to the micros. Our entire team is standing by with the CNBC TV 18 list of top 10 stocks for the morning. Anuj, as always, let's start with you. What's on your radar today?
So, the two stocks on the positive side today that, I'm seeing stocks which do well in a bad market normally tend to outperform. IGL is one stock which is outperforming not only market but its peers set, and has seen aggressive delivery-based buying. So that's first stock to watch. Federal Bank, I think, has been the best performing stock in an outperforming sector. The second generation private banks, South-based, which have been doing well. And it's seen consistent buying ever since its last quarter's numbers. Of course, positive news flow as well in terms of that MSME restructuring and all. That's helping. But consistent buying in this one.
Yesterday, Federal, DCB and some other banks, even public sector banks, which were expected to have a large MSME portfolio were up and about, and Federal is up. But Federal refused to confirm anything because they are on silent period. The results are due. So we are not able to confirm any numbers. The numbers doing the rounds is there is some 20,000 crore exposure to SME. But we couldn't confirm that figure.
Okay. But what about the merger ratios? That's finally out.
I think that's the big thing today, and that's going to be very good for Bob. Let's just look at the Bob Vijaya and Bob Dana ratio. 100 is to, let me put it in understandable numbers. One Bob share will be equal to 9 shares, 9.1 shares of Dana, and one Bob share will be equal to 2.5 shares of Vijaya. So if you hold 2.5 shares of Vijaya, you get 1 share of Bob, and if you hold 9.1 share of Vijaya of Dana, you will get 1 share of Bob. This ratio is quite clearly in favor of Bob, because if you do the math with yesterday's closing price, then Vijaya is at least 6% cheaper than it should have been. And Dana would be about 27% cheaper than it would have been. This is understandable because Dana Bank has a difficult portfolio of probably as yet unrecognized stress as well. So clearly today, Bob rises and these two stocks should fall. Dana should fall more than Vijaya. Also, just a couple of numbers which brokerages have given. The gross NPAs of the merged entity will be 11.8%, pretty similar to what is the gross NPA of BOB today, because Dana and Vijaya cancel each other, so to speak. Net NPAs will be a tad higher, but 5.3 instead of 4.9, which Bob currently has, which is okay. The CET1, again, another number which you'll watch at 9.1 will be very, very comfortable. But the total amount of BOB shares, I'm assuming that the amalgamated company is going to be called BOB. It could be called BOB Vijaya Dana or whatever it is called. But it will have to issue 30% more shares to the shareholders of Dana and Vijaya. That makes it a fairly large company. It'll be bigger than PNB for all you know, or almost as close, and a healthy company. So it could get into indices, is what some brokerages expect. If it does that, then perhaps BOB could trade even better. So good day for BOB. My guess is that would be green and the other two would be red.
Okay, we'll see how the rates play out on these stocks now that all the details of the merger are out. Well, speaking about details, we had the subscriber addition numbers for the month of October. Anisha is watching out for telecom stocks on the back of that. Anisha, what are the details?
Well, the key takeaway, Surabhi, is the fact that Jio continues to expand its subscriber base, and that is at the expense of Idea as well as Airtel. Now, to give you a few numbers, Reliance Jio has added around 1 crore subscribers in the month of October, and this has come at the expense of Vodafone Idea because their pace of losing subscribers has accelerated to 7.3 crore subscribers in the month of October versus a loss of around 6.7 lakh subscribers in the month of September. Bharti Airtel has also lost around 1.8 crore subscribers. And what does this do to the market share? Well, the market share for Reliance Jio has expanded to 22.5%, while that of Airtel has dipped marginally to 29.2%. So expect a tad bit of green tick on Reliance and a negative tick on Vodafone Idea as well as Airtel. Back to you guys.
Okay. Thanks a lot for that, Anisha. I would exclude Reliance because for them this is a small part, but expect red on the other two telecom stocks, I would think. Okay, Anisha, there is a fresh PPA that Tata Power has signed, but it's on expected lines, isn't it?
Well, yes, it's an expected line, Lata, but there was an overhang on the stock that this might not happen, and there was a bit of nervousness around it. Now, that goes away. Now, this is already regarding the BST or the best PPA that the company already is servicing, but the question was whether they will get the extension or not. Now, the answer is out that they have got the extension for the PPA of 670 megawatt for a period of 5 years, so should be sentiment positive.
Okay, I cannot understand. I mean, Tata Power officials were so troubled that this PPA... I mean, they've served, the Tata power companies have supplied power to Bombay for the longest time. Why this delay and why should it be 5 years? Why can't it be even longer? So anyway, I mean, I think this is uncalled for regulatory procrastination.
Well, now it's over. So that's, as Anisha said, it's one sort of red flag out of the way for Tata Power. Let's watch out for sugar stocks as well. Manglam will tell us what the news is here. Manglam.
Well, we're getting reports from various, media sources that UP is now in favor of increasing the minimum support price for sugar by 12%. So the minimum support price for sugar goes up from 29 to about 32.5 rupees per kg. However, a cursory Google search from the mandis tells you that the current market price of sugar itself is 33 rupees per kg. So let's see how much of an impact this has. However, it has an impact on all the other regions. So now we understand that farmers in Maharashtra too have started agitations to secure payments for the canes that have been crushed this season. Let's see how it goes. We do not have independent verification of this story, and the minimum support price is still perhaps lower than the current market price. Still provides a cushion on the downside to sugar prices.
Okay, so sugar stocks are going to be in focus as well. Moving on now to news that actually came in just as we were getting ready for the close yesterday. And it's now confirmed. Oil marketing companies like HPCL have stopped absorbing the ₹1 hit they were bearing on each litre of diesel and petrol sold starting the 4th of October. Anshu Sharma caught up with MK Surana, CMD of HPCL, on this development. Here's what he told her.
When the prices were high, government has requested that we should, oil marketing company should absorb ₹1 on the prices which we calculate on daily basis. Now 4th October onward, the prices are on the downside. I think the prices of petrol has come down by around ₹14 a litre or so. So it went up to 84, it is some less than 70 rupees now. Correct. So now that requirement right now is not there. So we are passing on the prices based on the daily calculated price.
Sir, does this mean that the base price of petrol and diesel was cut for ₹1 and the mechanism is still on with that?
No. See, the question is you calculate daily basis. At that time when the prices were high, we were absorbing ₹1.
So by when will you be able to recover that loss?
You see, right now we are passing on the prices based on the daily.